How does a specialized clothing company organically beat its own once-in-a-century pandemic peak while simultaneously having a massive artery of its global supply chain just suddenly severed by U.S. customs?
It's the kind of paradox that, honestly, it breaks traditional financial models. I mean, you're looking at a company that should, by all traditional retail logic, be issuing a desperate warning to shareholders right now.
Right.
But instead, they are aggressively raising their guidance and, pouring millions into buying back their own stock.
Welcome to this deep dive into the Q2 2026 earnings call for FI. Ticker symbol is FIGS. And look, if you work in healthcare, or even if you just know someone who does, you already know them.
Oh yeah, they're the absolute titan of the medical apparel space.
They really are. But if you're a retail investor trying to cut through the noise, what's happening beneath the surface of this quarter's numbers is, well, it's one of the most fascinating case studies in modern retail.
It really is.
So our mission today, we are keeping it Talk Tickers style. We are data forward, jargon free, opinionated, and actionable. We are tearing into the transcript to look at a massive beat and raise quarter, some truly wild accounting magic involving international tariffs, and a high stakes supply chain pivot that is testing the absolute limits of corporate agility.
And we really do need to look under the hood today because the headline numbers on this earnings print are almost blindingly good. Mm-hmm. Like if an algorithmic trading bot just scraped the top line data from this release, it would buy the stock without a second thought.
Instantly.
But as investors, we have to understand the physical mechanics behind those financial numbers. We need to know what is sustainable organic growth and what is just a temporary, albeit very welcome, accounting illusion.
Yeah, let's start exactly there because I want to hit you with the hard numbers straight from the transcript, and they are, frankly, eye-popping.
Hit me.
Okay, net revenues for the second quarter hit $196.6 million. Right, that is an incredibly impressive 28.8% year-over-year increase. And the context matters deeply here because this isn't a dead cat bounce or some lucky quarter. This marks their third straight quarter of 25% plus top-line growth.
Which is crazy. In the current retail apparel environment, stacking 3 consecutive quarters of growth north of 25% is practically unheard of.
Yeah. It really is.
You have major legacy consumer brands struggling to eke out low single-digit growth right now, and they're heavily relying on discounts and promotions just to move stale inventory off the shelves. FIGS is moving in the exact opposite direction.
Right, and moving down the income statement, diluted earnings per share, their EPS came in at $0.15. That absolutely crushes the $1.04 they reported in Q2 of 2025.
A massive beat.
It's a huge beat. And we're looking at active customers reaching 3.1 million, which is a 13.2% increase. But here is the number that jumped off the page for me.
Let me guess. The margins.
Yes. Quite honestly, it's the number that makes me instantly skeptical. Gross margin. Their gross margin popped to an astronomical 75.2%.
That's a wild number.
That is an 820 basis point increase year over year. And for anyone who doesn't speak Wall Street fluently, an 820 basis point jump just means an 8.2 percentage point increase.
Right.
So they went from roughly a 67% gross margin to 75.2% in 12 months. This is like a perfectly executed high-stakes surgery where everything went exactly to plan, maybe even better. But hold on.
Yeah.
We aren't talking about a software-as-a-service company where the marginal cost of adding a new digital subscriber is essentially zero.
Right. They sell physical pants.
Exactly. This is a physical apparel business. Mm-hmm. They are buying raw materials. They are spinning poly spandex blends. They are cutting, sewing, packaging, and shipping physical shirts across oceans. Gross margins in physical goods don't just naturally expand by 8.2 percentage points out of nowhere.
Yeah, they don't.
Unless you've suddenly discovered how to manufacture your product for half the price, or you've doubled your prices on the consumer. And they didn't do either of those things. What is the accounting magic happening here?
It's a great question, and your skepticism is entirely warranted. The cost of raw cotton and polyester hasn't plummeted, and they didn't suddenly start charging $200 for a pair of basic scrub pants.
Right.
What we are looking at here is a textbook example of why reading the footnotes of an earnings report is non-negotiable.
Yes. Always read the footnotes.
Because out of that 820 basis point expansion, 780 basis points, meaning almost the entire jump, was driven by a massive one-time cash recovery. It had absolutely nothing to do with unit economics or selling more scrubs at full price.
Okay, so peel back the curtain on this for me.
Yeah.
The transcript refers to this as a IEPA tariff refund. What exactly is happening here mechanically?
So mechanically, it's a fascinating piece of corporate litigation and accounting. IEPA stands for the International Emergency Economic Powers Act.
Okay.
It's a federal law that grants the U.S. government the authority to regulate commerce and impose economic sanctions or, elevated tariffs on imported goods, usually during periods of international trade disputes.
Got it.
So since February of 2025, FIGS had been caught in the crossfire of this. They had been forced to pay these highly elevated tariffs on specific goods they were importing into the United States.
So for the last year and a half, every time a shipping container of FIGS scrubs hit a port in Long Beach or Newark, they were handing over a much larger check to U.S. Customs than they historically had to.
Exactly. It was a massive drag on their profitability, and it was entirely outside of their operational control.
Right.
But behind the scenes, their legal and supply chain teams were aggressively fighting this. They filed petitions, argued their case regarding the classification and origin of their specific textiles, and crucially, they won.
Oh, wow.
Yeah. The U.S. government agreed that FIGS had overpaid under the specific parameters of these IEPA tariffs, and they issued a recovery.
And the size of that recovery is what's distorting the quarter. We're talking about a $15.4 million refund.
Real hard cash.
That is cash hitting their bank account, which is fantastic for the balance sheet. But how does a check from the government suddenly make their scrubs look vastly more profitable on an income spreadsheet?
That comes down to generally accepted accounting principles, or GAAP. Under standard accounting rules, when you pay a tariff to import a product, that cost doesn't just disappear. It gets capitalized into the value of the inventory.
Okay.
And when you finally sell that product to, say, a nurse in Chicago, that tariff cost is recognized on the income statement as cost of goods sold.
So it normally lowers your gross profit for that specific sale.
Precisely. Now, fast forward to this quarter. The government hands FIGS a $15.4 million check for tariffs they already paid. GAAP rules dictate that this refund must be applied as a reduction to their current cost of goods sold line item.
Ah.
I see. So for this specific 3-month window, their overall cost of goods sold artificially plummets by $15.4 million. When you have normal revenues coming in, but your accounting costs suddenly drop by over $15 million, your gross margin mathematically skyrockets to 75.2%.
Right. But the danger here for a retail investor is projection.
Absolutely.
Because if you look at that 75.2% margin and build your 5-year financial model, assuming Felgamy is now permanently operating with software-like gross margins, you're going to get completely burned.
You'll be way off.
This is a one-off event. I mean, it is a brilliant cash injection. It pushed their total liquidity up to $296.3 million, which means they have an absolute fortress of a balance sheet right now.
Unbelievable balance sheet.
But we have to mentally strip that noise away to see how the actual business of selling clothes is performing.
We do. And to be fair, management was very transparent about this. They broke down the refund to show exactly where it came from.
Right.
Like $7.9 million of that refund was actually for tariffs they paid all the way back in the 2025 fiscal year. Another $7.5 million was for the first half of 2026. And there's an additional nuance here. They have another $5.1 million in tariff reductions sitting on their balance sheet attached to inventory that hasn't been sold yet.
Wait, meaning that as those specific scrub sets currently sitting in the warehouse are eventually purchased over the next few quarters, we're going to see a slow trickle of artificial margin benefit continue to bleed into the income statement.
Exactly. It will slowly unwind over time. But your core question is the right one. If we strip all that tariff noise away, what is the actual underlying profitability of the company? Is the core business actually getting stronger?
And from what I read, the data suggests it absolutely is.
It is.
Because if we pull out the prior year portion of the tariff refunds, their adjusted EBITDA margin, which is basically their operational cash flow profitability, it still expanded beautifully.
Mm-hmm.
It surged to 18.6% compared to 12.9% in the exact same quarter last year. So even without the accounting magic, they added nearly 6 percentage points of core operational profitability. How are they pulling that off if it isn't raw material costs?
It's coming from 3 highly disciplined operational levers. First, they took some strategic pricing actions earlier in the year. Second, they are seeing much higher full price selling. They aren't relying on massive discount events or clearance sales to clear out inventory, which, protects the brand cachet and the margin.
Yeah, discounting kills brands.
It really does. But the third lever is perhaps the most critical for an e-commerce brand. They have significantly lowered their return rates.
I want to camp out on this point for a minute because I think anyone who doesn't work in e-commerce drastically underestimates how catastrophic returns are to a business model. A return isn't just a lost sale, it's an active financial penalty.
Oh, it's reverse logistics, and it is a margin killer.
Exactly. When a customer returns a pair of pants, the company pays for the return shipping label. Then the item arrives at a distribution center where a human being has to physically open the package, inspect the garment for stains or wear.
Yeah, make sure it's not damaged.
Right. It has to be refolded, rebagged, and placed back into the active inventory system. By the time that pair of pants is ready to be sold again, you've spent an enormous amount of labor and freight capital. So if FIGS is structurally lowering their return rate, that money drops straight to the bottom line. How are they actually doing it?
They attribute it to an obsession with something called fit blocks.
Fit blocks.
Yeah. Over the last few years, they have invested heavily in standardizing the exact physical dimensions and sizing templates, the fit blocks, across all their manufacturing partners globally.
Oh, okay.
It sounds simple, right? But maintaining sizing consistency in apparel manufacturing is notoriously difficult. A medium made in one factory on a Tuesday can fit very differently than a medium made in a different factory on a Friday.
Just due to like fabric stretching or sewing machine calibration.
Yeah, exactly. Or just human error.
But when a nurse finds their exact size in FIGS and they order 3 new pairs 6 months later, they expect absolute uniformity.
Right. By perfecting the fit block consistency, they ensure that a medium is always exactly a medium. The customer doesn't have to order 2 sizes intending to return 1.
Oh, I do that all the time with shoes.
Everyone does. But with FIs, they order with confidence, they keep the product, and those reverse logistics costs just evaporate. This intense focus on operational discipline is what drove that real tangible expansion to an 18.6% adjusted EBITDA margin.
So the financial foundation is incredibly healthy.
Yeah.
But, a healthy foundation only matters if the house is still growing. So let's look at what is driving this nearly 30% organic top-line revenue surge. Because I think there's a deeply ingrained narrative around FI that this specific earnings report actively shatters.
You're talking about the COVID stock narrative.
Precisely. The idea that they peaked during the pandemic and are on a downward slide. But let's look at the metrics that prove this wrong.
Let's do it.
Their average order value, or AOV, hit an all-time record of $127. That's up 8.5% year over year. But the most important metric in this entire transcript, to me, is their net revenues per active customer.
Yeah, this is huge.
Measured over a trailing 12-month period, it reached an all-time brand high of $229. That's a 10.1% jump. And a trailing 12-month spend of $229 means they have officially, definitively surpassed their COVID-era peak of $227.
And we really have to pause and explore the historical context of that $227 peak to understand why beating it now is such a monumental achievement.
Yeah, take us back to 2020.
Go back to 2020 and 2021. The macroeconomic conditions for healthcare apparel were wildly distorted.
It was an artificial, once-in-a-century demand spike. The entire global consciousness was focused on healthcare workers.
Exactly. You had everyday people buying premium scrubs as thank you gifts for the frontline heroes and their families. You had an unprecedented influx of federal funding flowing into hospitals. But more importantly, you had the explosion of the travel nursing industry.
That was the major catalyst.
Yeah.
You had nurses leaving staff positions to take short-term crisis contracts, making upwards of $8,000 to $10,000 a week?
Easily.
Exactly. And when your income suddenly quadruples, dropping $150 on a premium set of FIGS scrubs doesn't even make you blink.
Not at all.
It was a massive wave of discretionary spending within what has historically been a non-discretionary market. And for the last 3 years, the dominant bearish thesis on Wall Street has been FIGS was just a COVID darling. It was a fad.
Right. As the travel nursing bubble bursts, as hospital budgets tighten, and as inflation squeezes the consumer, FIGS will never recapture that 2021 level of demand.
It was a very logical thesis. We saw it play out across the entire pandemic-era tech and retail landscape.
Peloton, Zoom, all the e-commerce darlings, they all hit a massive peak and then suffered catastrophic mean reversions when the world normalized.
But the fact that FIGS has not only stabilized, but has now organically exceeded that COVID peak in Q2 of 2026, it's empirical proof that the product is a structural necessity, not a temporary trend.
I agree. And the growth is undeniably broad-based. It's not just price inflation masking lower volumes. The actual product mix is changing and expanding. Let's break down the categories.
Let's look at the breakdown.
Core scrubwear had record sales of $161.2 million, which is up 26.5%. But non-scrubwear is the real rocket ship in this report. Non-scrubwear grew 40.3% to $35.4 million.
We need to unpack what non-scrubwear actually means in this context, because I think it reveals the genius of their long-term product strategy.
Yeah, they refer to this as their layering system. They aren't just trying to sell a healthcare professional a standard V-neck top and a pair of pants. They are trying to outfit them from the moment they wake up through their entire shift to the moment they commute home.
Okay, so what does that include?
This includes underscrubs, proprietary outerwear like fleece jackets and vests, compression socks, and various accessories.
And the reason this works so well goes back to the physical environment these customers operate in. A hospital is not a comfortable place.
No, it's not.
It is an intensely, aggressively climate-controlled environment. If you are working in the ICU, it might be freezing cold to prevent bacterial growth. If you are rushing down to the emergency department, you are sweating. A layering system for a nurse isn't just a fashion statement or a luxury. It is a functional daily necessity to survive a 12-hour shift.
It is a performance environment, much like an athletic field. And FIGS is treating healthcare apparel with the same technological seriousness and R&D investment that a company like Nike treats marathon running or, Lululemon treats yoga.
Yeah, they started with their proprietary FIONx fabric, which was revolutionary for scrubs.
It really was. It featured 4-way stretch, anti-wrinkle properties, liquid repellency, and antimicrobial treatments. It fundamentally changed what scrubs felt like.
Because before FIONx, traditional hospital-issued scrubs were essentially just boxy, scratchy cotton polyester blend sacks. They were designed to be bleached and washed industrially, but they were incredibly uncomfortable and ill-fitting.
Right. But FIGS didn't stop with FIONx. They have since introduced Formex, which is an even more specialized high-performance fabric, and on this call, they announced they're debuting something called Fibrex.
Wow, they just keep innovating on the textile side.
They are building an entire ecosystem of technical textiles. When a nurse buys a FIONx scrub set, they inevitably realize they need a jacket that matches that exact colorway and technical performance. So they buy the FIOS fleece. Then they need the underscrub. The share of wallet just naturally expands.
This brings us to what I consider the most fascinating economic mechanism in the entire ATS business model. I like to call it the walking billboard effect. Yeah. The environment of a hospital fundamentally alters the traditional mathematics of customer acquisition cost, or SAC.
I think this is the most critical competitive moat they possess. How would you describe the mechanics of it to someone who doesn't follow retail?
Okay, think about traditional premium apparel marketing. If I buy a really nice, expensive jacket from a boutique brand, who sees it? Maybe my friends see it when we go out to dinner on a Friday night. Or maybe my coworkers see it for 30 seconds while I walk from the parking lot to my cubicle before I take it off.
Right, very limited exposure.
Exactly. My personal network effect for that brand is incredibly small and dispersed. But a nurse, a respiratory therapist, a resident doctor, they work 12-hour shifts in densely packed, highly stressful institutions.
Yeah.
They are surrounded by hundreds of other healthcare professionals who all have the exact same rigid uniform requirements. When one nurse on a med-surg floor finally gets fed up with their scratchy hospital scrubs and upgrades to a tailored, perfectly fitted, brightly colored set of figures, they wear them for 12 hours a day in front of 50 of their peers.
It's an incredibly concentrated, localized network effect.
Exactly. Every single other nurse on that floor notices. They ask, are those the new figures? How do they feel? Is the stretch actually that good? The product itself acts as the primary marketing vehicle.
Yeah.
The first customer on the floor might have cost FIGS $30 in Instagram ad spend to acquire, but the next 5 customers on that floor, they are acquired organically through word of mouth and physical product demonstration in the break room. The customer acquisition cost for those subsequent users effectively drops to near zero.
And we are seeing the mathematical proof of that walking billboard effect in the financials right now.
Where did it show up?
Chief Financial Officer Sarah Oughtred explicitly called out their digital customer acquisition efficiencies on the call. Despite growing top-line revenue by nearly 30%, their marketing spend as a percentage of revenue actually dropped. It went from 15.2% of revenue down to 14.5% this quarter.
That is the holy grail of retail.
Yeah.
Massive operating leverage. You are getting significantly more revenue for every marginal dollar of marketing you spend, because the existing customer base is doing the heavy lifting for you.
And they are fiercely protecting and expanding the sheer size of what they can sell to that captive audience. This leads us into how they are expanding their TAM, their total addressable market.
Yes, let's talk about TAM.
Because FIGS is clearly demonstrating a strategic shift. They aren't just selling medical uniforms anymore, they are selling a holistic healthcare lifestyle. Management spent significant time on the call, highlighting 3 specific strategic moves this quarter that represent a massive widening of their aperture.
Let's start with the most surprising one, the acquisition of V Coterie.
Yeah, this was fascinating. V Coterie is a micro-acquisition. They are a brand that specifically makes healthcare-themed jewelry, enamel pins, and stethoscope charms.
It was founded by a former dentist named Lina Van Murky, right?
Yeah.
And FIG actually just brought her in-house to be their head of pins, charms, and jewelry.
Yes, which, by the way, is an incredible corporate job title.
It really is.
Yeah.
Now, on the surface, selling little $15 enamel pins and stethoscope charms might seem trivial, almost a distraction compared to running a $160 million quarter in core scrubwear. Like, why bother with the operational headache of sourcing and shipping tiny pieces of metal?
It's a fair question, but you have to view this through the lens of psychology, identity, and personalization.
I couldn't agree more. Think about the fundamental nature of a uniform. The entire point of a uniform is to strip away individuality in order to create visual conformity, authority, and hygiene.
Right.
You walk into a hospital and everyone is reduced to a color code.
Yeah.
Navy for nurses, seal blue for doctors, burgundy for techs.
It is inherently dehumanizing in a functional way.
Exactly. V Coterie is the antidote to that conformity. It allows the individual to reclaim a tiny piece of their identity within the strict rules of the hospital floor. A nurse can wear a little pin celebrating their specific graduation year, or a charm showing they specialize in the NICU, or a piece of jewelry that simply adds personal flair.
It allows them to signal their expertise and their personality.
Yeah.
And emotionally, it binds the customer to the brand on a much deeper level. It's the same psychological mechanism that Crocs uses with their Gibbets charms. The base product is the canvas, and the high-margin accessories allow for infinite personalization.
Oh, that's a great comparison.
The CEO of FIGS, Trina Spear, framed this perfectly on the call. She said, lazy companies sell into a TAM, and innovative companies create TAM.
I love that quote.
It's aggressive, but it's accurate. They are literally inventing a new category of discretionary spending within a non-discretionary market. They are monetizing the desire for self-expression. And the margins on jewelry and small accessories are typically astronomical compared to heavy apparel.
Oh, absolutely.
Yeah.
But they aren't just relying on microtransactions and emotional connection. They are pairing that consumer psychology with massive, hard-nosed B2B enterprise sales.
We have to talk about the Teams platform because this is where the scale of the company could fundamentally transform.
Yeah, Teams is their dedicated business-to-business platform. Up until recently, FIGS has been overwhelmingly a direct-to-consumer brand. You know, the individual nurse goes to the website and buys their own scrubs with their own credit card.
Right.
But the Teams platform is designed to outfit entire healthcare institutions, clinics, hospitals, private practices in one centralized procurement process. And this quarter, they announced a massive landmark contract win.
They secured Bupa Dental Care. Yes. Bupa is a division of the British United Provident Association. It is one of the largest private healthcare and insurance companies in the world. Through the Teams platform, FIGS is now contracted to outfit nearly 400 individual dental centers across the United Kingdom.
I want to dig into the mechanics of why a B2B uniform platform is so incredibly sticky, because it changes the valuation multiple of the business.
It really does.
If I'm an individual retail consumer, my purchasing habits are relatively fickle. Maybe I buy 3 sets of FIGS this year, but next year inflation is high, my budget is tight, and I decide I can stretch my current wardrobe for another 12 months. My revenue stream is unpredictable.
Sure.
But if you are a corporate procurement manager outfitting 400 separate dental clinics across an entire country, the logistics are a nightmare. Let's look at how this used to work. A hospital would give an employee a paper catalog and a $200 annual stipend.
Old school.
Very. The employee orders from 3 different legacy vendors. The navy blue from vendor A doesn't match the navy blue from vendor B. Sizes are out of stock. The administrative burden on the hospital's HR and accounting departments to track these individual stipends is massive.
It's highly fragmented and deeply inefficient.
What FIGS does with the TMS platform is essentially the saucification, the software as a servicification of retail apparel. They go to a corporate entity like Bupa and say, we will build you a custom branded digital portal.
Wow.
All of your employees get a unique login. Their stipend is preloaded. They can only see the specific colors and styles your clinic approves. We handle the sizing, the shipping, and the returns directly with the employee.
It removes the entire logistical headache from the hospital administrator's desk.
Exactly. And once a massive entity like Bupa integrates their entire employee roster into the FIGS team's digital portal and standardizes their brand colors across 400 clinics, the switching costs become astronomically high.
Oh, yeah. To rip out the FIGS system and move 400 clinics to a different uniform provider would require retraining staff, dealing with mismatched uniforms during the transition, and rebuilding the digital backend.
They won't do it.
No, they won't. It creates a deeply entrenched, highly predictable, recurring revenue stream.
And that Bupa deal acts as the perfect bridge into the third massive growth lever management focused on international expansion.
Yeah, Bupa is, of course, a UK-based entity, which highlights the traction FES is gaining overseas. International net revenues this quarter hit $37.9 million. That is a staggering 67% year-over-year increase. They are now actively operating in 85 global markets, having just opened 27 new markets year to date.
But here's where I usually get nervous with hyper-growth consumer brands. When a brand says they just launched in 85 countries, what that often means is they just flipped a switch on their Shopify backend that allows international shipping via DHL, and they call it a global expansion.
Right. It's an illusion.
Exactly. True international penetration, actually building brand equity in a foreign culture, is incredibly expensive and difficult. What is their actual operational playbook here?
You're right to be skeptical because shotgunning marketing dollars blindly across the globe is a great way to incinerate cash. But FIGS' international strategy is highly calculated. Management described it as a bifurcated model. Go broad and go deep.
Walk us through the go deep methodology first.
The go-deep markets are their proven high-traction regions. Right now, this includes places like Canada, Australia, the UK, and increasingly Mexico. In these markets, they are deploying full-funnel marketing.
Meaning what, practically?
They aren't just running digital ads, they are localizing the brand experience. For example, they just hosted their first ever in-person Nurses Week activation event in Toronto. They are hiring local PR agencies, they are setting up localized distribution nodes to reduce shipping times, and they are aggressively driving direct conversions. Mexico, in particular, was singled out on the call as performing exceptionally well under this strategy.
Okay, so that's where they are actively harvesting demand. What about the go broad markets? How do you manage the other 80 countries without bleeding capital?
The go broad markets are essentially incubators. They are planting seeds with minimal capital expenditure. The strategy here is hyper-targeted digital localization. They look at the specific digital channels that dominate the local culture of healthcare workers in a given country.
Okay, interesting.
For example, they are ramping up ambassador R&D on the Line messaging app in Japan. In South Korea, they are focusing on the Kakao app. In China, they are penetrating through Douyin.
So they are recruiting a handful of highly influential local healthcare professionals in Seoul or Tokyo, giving them the product and letting them generate organic, user-generated content on their native platforms.
Exactly. They keep the marketing spend extremely light and highly focused on organic social proof. They monitor the data closely. Once a go broad market gains enough critical mass and organic traction, once the metrics prove that the local healthcare culture is resonating with the product, it earns the right to be upgraded to a go deep market.
Only then do they unlock the millions of dollars in dedicated, localized performance marketing spend.
Yes.
It is a remarkably disciplined capital allocation strategy. They are forcing the organic demand to prove itself before they write the big checks. And we see that same disciplined approach in their physical retail strategy, which they refer to as community hubs.
Yes, the physical retail component is fascinating. Right now, operating at nearly an $800 million annual revenue run rate, they only have 5 physical stores.
Which is insane efficiency.
Yeah.
But they are stepping on the gas now. They announced 4 new leases signed for later this year. Scottsdale, Arizona, Tyson's Corner just outside Washington, D.C., Valley Fair near San Jose, and Aventura Mall in Miami.
Prime real estate.
And if you look closely at these specific locations, the strategy is brilliantly obvious. These aren't random strip malls off a highway. These are premium, A-tier luxury malls.
And more importantly, they are geographically anchored near massive, affluent hospital networks. Tyson's Corner serves the enormous healthcare ecosystem around the nation's capital. Valley Fair is dead center in the wealthy Silicon Valley medical corridor. They're placing these physical flagships directly in the path of high-earning healthcare professionals.
And a physical store for FIGS isn't just about moving inventory. Remember the sizing issues we talked about earlier with the fit blocks?
Yeah.
A physical store serves as a permanent, high-end fitting room. A nurse walks into the Scottsdale store, tries on the Fahon X pants, figures out exactly what size and fit block works for her body, buys a set, and then goes home and confidently orders online for the next 5 years.
That makes total sense.
The store is an acquisition tool that drives permanent digital retention. When you look at the sheer size of this company and the fact that they're just now starting to roll out physical locations, the runway for footprint expansion over the next decade is massive.
Oh, yeah. Compare them to a Lululemon, which has hundreds of stores globally. FIGS is just at the starting line of omni-channel retail.
Which naturally leads us to the critical turning point of this earnings call. Management guidance for the rest of the year.
Right.
With all of these tailwinds, the explosive growth in the TMS platform, the international expansion, the new physical retail hubs, and the new categories like outerwear and jewelry,
Yeah.
what is management explicitly promising Wall Street for the back half of 2026?
They came out incredibly aggressive. Management officially raised their full year 2026 net revenue guidance to approximately 20% year-over-year growth.
Wow.
To put that in perspective, their previous outlook was sitting between 14% and 16%.
Taking guidance from roughly 15% to 20% mid-year on a revenue base approaching $800 million requires an immense amount of absolute confidence.
It does. They also bumped their adjusted EBITDA margin guidance to a range of 14.8% to 15.0%, up from the low 13s. They told investors they expect the third quarter to grow by approximately 20% year over year and the fourth quarter to grow by 10%.
And we should clarify that fourth quarter figure for you, the listener, because a drop from 20% growth in Q3 to 10% growth in Q4 might look like a deceleration on the surface. But it is vital to understand the comps, the comparables.
Yeah, the comps are tough.
In Q4 of this year, they will be measuring themselves against an absolutely monstrous Q4 from the prior year, where they saw a massive 33% growth acceleration. Lapping a 10-3% growth quarter and still stacking another 10% on top of it is a sign of extreme structural health, not a slowdown.
Okay, so we've laid out the bullish narrative. The numbers are fantastic. The strategy is flawless. The TAM is expanding. The guidance is raised.
Yep.
But this is where I have to step in and play devil's advocate.
Please do.
Because the tone of this call was almost euphoric, but buried deep in the back half of the transcript during the Q&A session, there is a hidden massive operational risk. And is a risk that could theoretically derail all of this raised guidance if management miscalculates even slightly.
We have to talk about the WRO.
Yes, the WRO in Jordan. When I read this part of the transcript, I literally stopped and reread it 3 times.
I did the exact same thing.
Because the dissonance between raising revenue guidance to 20% while simultaneously admitting that a major piece of your global supply chain has been shut down by the federal government is wild.
Okay.
I need you to break down exactly what a WRO is and what is happening in Jordan.
It is the single biggest point of friction in the entire report, and it requires very careful objective analysis. WRO stands for Withhold Release Order.
Okay.
It is a highly powerful enforcement mechanism utilized by U.S. Customs and Border Protection. Essentially, under U.S. law, Customs has the unilateral authority to detain and prevent any merchandise from entering the United States if they suspect, based on reasonable evidence, that the goods were produced in whole or in part using forced labor, or under conditions that severely violate international labor standards.
So to be completely clear, U.S. Customs threw up a brick wall at the maritime border. Any shipping containers full of FIGS products coming out of their partner manufacturing facility in Jordan are currently halted and prevented from entering the U.S. market.
Correct. The importation from that specific facility is frozen. Now, we must be explicitly clear here. The earnings transcript does not confirm any wrongdoing, and IG This is not accused of utilizing forced labor.
Right.
The WRO simply means the order is in place pending investigation or remediation regarding that specific third-party manufacturing partner in Jordan. But regardless of the ultimate findings, the logistical reality for FIGS is immediate, severe, and highly disruptive. Historically, Jordan has been a highly significant node in their global supply chain, responsible for manufacturing a large volume of their core scrub styles.
Okay, let's explore the mechanical reality of this. If you are an apparel company, you design your products months, sometimes a year in advance. You allocate raw fabric to a factory, they cut it, they sew it, they box it, and they put it on a cargo ship. If a massive artery of your supply chain is suddenly severed, if the factory in Jordan is effectively taken offline for the US market, how on earth do you pivot fast enough to avoid completely stocking out of your core products right before the Q3 back-to-school season?
It requires an unbelievable amount of operational agility, deep relationships with other manufacturing partners, and quite frankly, a willingness to burn cash.
A lot of cash.
Management noted on the call that because of the broader ongoing geopolitical disruptions and shipping lane issues in the Middle East, they had already begun the process of proactively de-risking their reliance on that region.
Okay, so they saw some trouble coming.
Right. When the WRO hit, they immediately pivoted to leverage excess capacity with other strong existing partners in their network, primarily pointing toward massive facilities in places like Vietnam.
They shifted the order volumes. But shifting an order volume on a spreadsheet is easy. Getting a factory in Vietnam to suddenly spool up production of an extra 500,000 units of scrubs that were supposed to be made in Jordan is incredibly difficult.
It's a logistical nightmare.
You have to secure line time, transfer the fit blocks, source the exact AEONX fabric, and physically manufacture the goods. But even if they accomplish that miracle, there is an inescapable law of physics standing in their way: the Pacific Ocean.
And that is where the cash burn comes in. Because expedited production isn't enough if the finished goods are sitting on a slow-moving cargo ship chugging across the ocean for 45 days.
Exactly.
If they rely on standard ocean freight measured in TEUs, or 20-foot equivalent units, they will miss the Q3 revenue window, they will stock out on the website, and that 20% raised guidance goes up in smoke.
Which is why management explicitly stated that they are going to utilize massive amounts of air freight to mitigate inventory disruptions in the second half of the year. They are going to load these scrubs onto cargo planes and fly them from Southeast Asia directly into their North American distribution centers.
And we have to explain the economics of this. Moving heavy textiles via air freight is exponentially more expensive than ocean freight. You are paying by the kilogram for jet fuel.
It's brutal for margins.
It is the absolute last resort for an apparel brand because it mathematically obliterates the gross margin on those specific units. In fact, CFO Sarah Autrid noted that the exorbitant costs of this emergency air freight will largely offset some of the positive margin benefits they expected to realize from general tariff rate reductions later this year.
Wow.
Let me try to frame the sheer audacity of this supply chain pivot with an analogy, because the typical business reaction to a disruption of this magnitude is to temper expectations and lower guidance. But agrees to do that.
No, they raised it.
Think about a major city's transit network. The ocean freight from Jordan was their main subway line, efficient, cheap, moving massive amounts of volume on a predictable schedule.
Okay.
The WRO essentially means the central subway station just caved in right before rush hour. Millions of commuters still need to get to work. A normal company would tell the commuters, sorry, you're going to be late.
Right, expect delays.
But FIGS is saying, no one will be late. Instead of relying on the subway, they are scrambling to rent a fleet of 10,000 Ubers, which is the air freight from Vietnam, to drive every single passenger to work individually. It is going to cost an absolute fortune, it requires perfect logistical coordination, and yet they are confidently promising their investors that they're going to transport more passengers today than they ever have in the city's history.
That is a remarkably accurate analogy. The WRO is the collapsed subway. The expensive Ubers are the air freight. And the raised guidance of 20% top-line revenue growth is the promise to break records despite the chaos.
It is a staggering display of confidence. But why are they so confident they can pull this off? What is unique about FIGS that allows them to pivot a supply chain this aggressively?
It comes down to SKU complexity, or rather, the lack of it.
Elaborate on that.
Management noted on the call that their specific business model makes them a manufacturer's dream. Think about a traditional fast fashion brand. They might ask a factory to produce 500 completely different, highly complex, intricately designed styles every single month in small batches.
Which requires constant retooling of the sewing machines and massive administrative overhead.
Exactly. FIG operates on a high-volume, low-SKU model. The vast majority of their revenue comes from a very tight curation of core styles, like the Catarina top and the Zamora jogger pants, in a few core colors like navy, black, and seal blue.
I see.
Because they aren't asking a factory to make complicated bespoke designs, they can go to a massive, highly sophisticated facility in Vietnam and say, we need you to spool up production of 100,000 basic Catarina tops in navy blue immediately. The factory doesn't have to think. They just turn on the machines and run them at maximum capacity. The simplicity of the product design enables the speed of the pivot.
But as an investor, you have to monitor this like a hawk. Confidence is great, but logistics are unforgiving. Management expects their Q3 inventory levels to actually be down double digits year over year as they navigate this choppy transition period.
Yeah, there's no room for error.
If a typhoon grounds the air freight out of Vietnam for 3 days, or if the alternate facilities hit an unexpected snag with fabric sourcing, you could see the core navy and black scrubs simply go out of stock on the website.
And the moment those core items are unavailable, the revenue machine halts.
And that 20% growth projection is completely dead in the water. The fact that they raised guidance despite this WRO hanging over their heads is either a testament to unparalleled operational excellence or it is incredibly dangerous hubris. We won't truly know until the Q3 results print in November.
It is a high wire act without question. Which brings us to the ultimate question we have to answer today. We have synthesized an immense amount of data.
We really have.
We've looked at the stellar 28.8% top-line growth. We've unpacked the $15.4 million tariff cash infusion accounting magic. We've explored the brilliant TAM expansion into the Teams platform, the V Coterie jewelry acquisition, and the hyper-targeted international strategy. And we have deeply analyzed the very real, highly expensive WRO supply chain risk.
So taking the entirety of this incredibly complex diagnostic landscape into account, what is the final verdict for the retail investor listening to this deep dive right now? Are we viewing this quarter as a bullish signal or a bearish one?
I'm curious where you land on this because there are compelling arguments on both sides.
I am taking a definitively bullish stance on FIGS. And the why for the long-term investor comes down to 3 deeply fundamental pillars that, in my view, completely outweigh the short-term margin noise of tariff refunds and the logistical headaches of the WRO pivot.
I am leaning the exact same way. Let's synthesize those pillars. Where does the confidence come from first?
The first pillar is the underlying health of the customer base. Lapsed customers are returning, and existing customers are accelerating their purchases. During the Q&A segment of the earnings call, several analysts pressed management hard on exactly where this 28.8% growth was coming from.
Right. They wanted to know if it was just bot growth.
Exactly. Their fear was that ABS was just using that tariff cash to fund massive, inefficient top-of-funnel marketing campaigns, essentially buying low-quality new eyeballs.
But that isn't what is happening.
No. The active customer base grew by 13%, but that growth was heavily driven by lapsed users, people who hadn't bought anything in a year or more, suddenly returning to the platform. Furthermore, management noted that the days between purchase metric for their active cohorts is actively shrinking.
That is a phenomenal indicator of product market fit. It proves the core thesis we discussed earlier. The product is a non-discretionary necessity, not a pandemic-era fad.
Think about the macro tailwinds here. The healthcare industry in the United States is adding an average of 50,000 new jobs every single month this year. The population is aging, the demand for medical care is structurally skyrocketing. These millions of professionals need uniforms to physically go to work.
They absolutely do.
And the data shows that once a nurse experiences the technological comfort of FIOX or Formex fabrics, the idea of going back to the scratchy, ill-fitting hospital-issued scrubs becomes unthinkable. They are replenishing their wardrobes at higher and higher rates, accelerating their spend. The underlying demand is rock solid.
I completely agree. And that leads perfectly into the second point, which is one of the strongest signals a retail investor can ever receive. Management is putting their money exactly where their mouth is regarding the valuation of the company. Let's talk about the buybacks.
Oh, the buybacks are huge.
We know they have nearly $300 million in total liquidity, but what are they doing with that cash? During the second quarter, FIGS aggressively repurchased $24 million of their own shares in the open market at a weighted average price of $11.94 per share.
And the signal gets even stronger because they didn't stop there.
No, they didn't. The board of directors just authorized a brand new, massive $100 million share repurchase program. That brings their total available war chest for buying back their own stock to $119 million.
Now, let's look at the psychology of this move. When a management team aggressively buys back stock and arms themselves with another $100 million to keep doing it, it sends a crystal clear, unmistakable signal to the public market. The insiders believe the underlying intrinsic value of the company is significantly higher than the current trading price.
They view their own equity as the single best possible investment they can make with their capital.
It is the ultimate confidence indicator, and the context makes it even more powerful. They're executing these massive buybacks while simultaneously staring down the barrel of a major supply chain pivot and incurring highly elevated air freight costs.
They are essentially communicating to Wall Street, we see the WRO risk, we see the supply chain disruptions, we know exactly how much the air freight is going to cost, we see all of it, and we are still buying our own stock with both hands because the long-term cash flow generation of this business is deeply undervalued.
It takes immense conviction to execute that strategy.
It really does. Which brings us to the third, and in my opinion, the most powerful pillar of the bullish thesis. It is the holy grail of consumer retail. FIGS is actively building a cultural monopoly.
There was a specific quote from CEO Trina Spear at the very end of the earnings call that I think encapsulates the entire investment thesis of the company perfectly.
I know exactly the quote you mean. She said, "There are now more searches for FIGS than there are for scrubs."
Let the magnitude of that statement sink in. When a specific brand replaces the generic noun of the actual product in the cultural lexicon, they have constructed an almost impenetrable competitive moat.
You don't ask a coworker for a tissue, you ask them for a Kleenex.
You don't ask for an adhesive medical strip, you ask for a Band-Aid. You don't tell your friends you are going to hail a rideshare application, you tell them you are going to call an Uber.
And when nursing students graduate and get their first job in a hospital, they don't go to Google and search for premium medical uniforms. They don't search for four-way stretch scrubs. They just open their phone and search for Evis.
They have completely captured the mindshare of the demographic, and they are cementing that mindshare through deep structural cultural integration. We've talked about the localized Nurses Week events in Toronto, but look at what they are doing on a macro level.
What do you mean?
They organized a massive event called the Healthcare Human Rally in Washington, D.C., where they physically brought hundreds of healthcare workers and celebrities like actor Noah Weil to literally lobby the United States Congress for the Dr. Lorna Breen Act to secure better mental health services for medical professionals.
Wow. They are not just selling pants. They are integrating themselves into the political, social, and emotional lives of their consumers. They are advocating for them on a federal level.
You cannot easily disrupt a competitor that is that deeply, authentically embedded in the core identity of its customer base. A cheaper knockoff brand on Amazon might be able to copy the poly spandex blend, but they cannot replicate the cultural loyalty IGS has built.
And that is exactly why, despite the highly complex accounting nuances of the tariff refunds, and despite the very real logistical fires burning in the Jordan supply chain, the underlying fundamental momentum of the business is undeniably bullish.
Yeah.
The ecosystem they are building is comprehensive. From the core Phoenix scrub technology to the high-margin V Coterie jewelry personalization to locking in 400 Bupa dental clinics on a B2B SaaS platform to opening premium retail stores in Miami and Scottsdale, every single cylinder of this engine is firing in unison.
So what does this ultimately mean for you, the listener? Well, let's bring this all the way home. I want you to take a hard look at your own investment portfolio right now. Look past the tech stocks and the index funds and look specifically at the consumer retail brands you hold.
Ask yourself a very difficult question. How strong is their brand moat, really?
Are they just fighting a brutal, endless race to the bottom on price discounts and expensive Google Ads placements? Or are they actively transcending their category? Are they successfully becoming the generic noun for their entire industry? Are they a Kleenex? Or are they just another generic tissue fighting for shelf space?
Because as FIGS is mathematically proving this quarter, when you truly own the cultural conversation and you build a product that your customers view as a functional necessity, you can survive major supply chain disruptions.
You can outrun macroeconomic inflation, you can generate massive operational leverage, and you can sustainably expand your margins. It is the ultimate differentiator in modern retail investing.
It separates the enduring brands from the fleeting trends.
I want to leave you with a final provocative thought to mull over as we wrap up this deep dive. We have spent an enormous amount of time today unpacking how FGS has successfully transcended basic scrubs to own the entire healthcare lifestyle. Let's zoom out and look at the blueprint they used.
Yeah, they took a massive, inherently boring, heavily commoditized, deeply unglamorous, highly mandated uniform, and they systematically injected it with proprietary performance fabrics, limited edition color drops, aspirational lifestyle marketing, localized network effects, and high-margin, personalized accessories.
It is an absolute masterclass in the premiumization of a utility product. So my question for you to explore on your own is this. What other highly specialized, mandatory, unglamorous uniform markets are currently sitting right in front of us, massively underserved and completely ripe for a FIGSification disruption?
It's a fascinating intellectual exercise. You start looking around and realizing how many massive workforces are wearing terrible apparel. Think about the culinary arts and hospitality. Think about aviation mechanics. Think about the millions of skilled tradespeople or postal carriers.
Exactly. Who is going to successfully execute this exact playbook for the millions of restaurant workers who are currently wearing terrible, stiff, stain-prone aprons and generic chef coats? Who is going to do this for the mechanics who are wearing heavy, unbreathable coveralls?
The blueprint for how to build a multi-billion-dollar cultural monopoly out of a mandatory uniform has been published by FIGS for the entire world to see.
The capital is waiting. The market is waiting. It is just waiting for the next visionary founder to apply this exact model to a new industry. We started this deep dive talking about the paradox of beating a pandemic peak while a supply chain burns. We explored the desire for clean binary numbers on an earnings sheet and how quickly those numbers get murky when you introduce international tariffs, reverse logistics, and U.S. customs enforcement.
And while the surface numbers of this specific quarter looked perfectly clean, diving into those muddy, complicated waters revealed a much more complex, much more fascinating reality of how global retail actually operates.
But as we've seen today, sometimes it is only by wading deeply into those complicated operational waters that you realize just how incredibly strong the underlying foundation of a company really is. Thank you so much for taking this deep dive with us today. Keep looking past the headlines, keep questioning the gross margins, and always read the footnotes. We will catch you on the next one.